it's going to be a very interesting session which we all are going to conduct. Today we have a very special and amazing speaker with us. I'm sure we all have heard her before this, but definitely it's always a pleasure to hear her again and again. Please welcome Miss Shibani Kurian. She's the most amazing speaker I have heard so far. So I will just quickly give you the overview of what Shibani have done in past. So Ms. Shibani Kurian has a PGDM specialization in finance, BSc Honors Economics. Ms. Shibani Kurian has a total experience of 20 years in the Indian equity market, of which almost more than 12 years have been with Kotak Mahindra Asset Management Company Limited. Her primary responsibility includes equity fund management and heading the equity research team. Prior to joining Kotak Mahindra Asset Management Company Limited, she worked for almost 6 years with UTI Asset Management Company Limited and for 1.5 years with Downer Day AV Financial Services. She holds a PGDM with a specialization in economics and finance from TA Pai Management Institute, Manipal, and BSc Honors in Economics from St. Xavier College, Kolkata. So it's our pleasure to hear Shibani, and thank you for coming and sparing your weekend with us. Thank you. Over to you, Shibani. Thank you so much.
Thank you so much for the very kind introduction, and good morning, everyone. Pleasure to be here. Now, before we just start the discussion on our NFO, which has opened yesterday, or day before yesterday, which is on 31st of August. But I just wanted to set the context for the market and why we think that this is the right time to look at an asset allocation fund. If you look at our markets in the last few years, since the COVID lows, India actually has been among the best performing markets globally. So there have been three key factors that have driven the outperformance of the market. One has been that our macroeconomic parameters have been very resilient. So growth, inflation, interest rate, current account deficit, all have been fairly good and resilient. And therefore, from a relative macro perspective, India has been like an oasis in the desert. The second factor that has helped equity markets has been corporate earnings. And to give you an example, from 2020, corporate profit to GDP in our country has moved up from about 2.3% to almost 4.3%. So in the last 3 years, corporate profitability has grown at a CAGR basis of almost 34%. And that has been one of the primary drivers for the re-rating of our markets. And the third has been flows. And as you know, that domestic flows have been strong all these years, but now even FII flows have picked up substantially. And calendar year to date, we have seen more than $16 billion of net FII flows coming into India. So all these three factors have meant that our markets have been on an up move. But one factor that we can't, ignore when we look at markets is valuations. So today, when we look at valuations for the Nifty, the valuations are trading slightly above long-term averages. And therefore, our belief is that while structurally the market fundamentals remain very strong, because valuations are no longer cheap and they have moved above the fair value range, we should be looking at asset allocation more closely. And in that context, we present to you the Kotak Multi-Asset Allocation Fund, which, as I mentioned, the NFO has already opened and it closes on the 14th of September. So as we start this presentation, let me also say that this is a fund that will be investing in debt, equity, as well as commodity. And there is also a provision for overseas investments. And as we run this presentation, I'll explain each of these categories in more detail. So Mausam, next slide, please. Yeah, so all of us know that, our lives are all hectic. In fact, some days you feel that even 24 hours in a day is short and wish we had more time. And in all of this, how do we ensure that our financial planning is being done properly? Asset allocation is taken care of. And therefore, in this context, especially the way our lives are, a multi-asset allocation fund where you leave the headache of asset allocation to the fund manager makes immense amount of sense. Next slide. Also, when we look at any business, whether it be our distribution business or whether it be any corporate, the 80-20 rule typically applies. So what is the 80-20 rule? So if you just think back, you will look that 80% of your clients typically contribute 20% of your revenues, and actually only 20% of your clients provide the majority of your revenue. So more often than not, 20% of your client base are those who provide 80% of your revenues. And therefore, as a distributor, you would need to find more time to service that 20% of your client base, and also ensure that the servicing of the 80% of your client base is more and more efficient. And how can you do that? You can do that by offering to that 80% of your client base a product like the multi-asset allocation fund. Next slide. So if you look at the multi-asset allocation fund for 80% of your clients, this will help in terms of, again, putting the entire burden of asset allocation to the fund manager. So you are leaving it to the professional fund manager to do the job of asset allocation. It will also help attract larger long-term investments from your investors, because here clearly the focus is on long-term investments, because only then will you gain from moving from one asset class to the other. Also, this will mean that the efficient way of addressing the client queries that you get from 80% of your clients will be addressed, and that will leave you more time to focus on your important clients. So that's just one thought from a multi-asset allocation product perspective. Next. So the question that we often get is that, you are launching a multi-asset allocation fund today, but there are many other funds in the market. So do you have any experience in managing assets? In fact, we have considerable amount of experience in managing these assets. For instance, we already have a Kotak multi-asset allocator fund of fund, where we have been extremely dynamic in managing the equity portion. So as you see that since inception, what we have done is that the minimum net equity in the fund of fund has moved from 9% to a maximum of 99%, and average net equity has been about 69%. So not only have we had experience in managing multi-assets, we've also been extremely dynamic in terms of. And let me also point out that since inception, this fund, which is the Kotak multi-asset.
Shibani, sorry to interrupt in between, but your voice is not audible.
Better? Better?
Yeah, much better now.
Sorry?
Yeah, it's much better now.
Okay.
You can continue. Thank you.
Yeah, so I'll just repeat this one bit again. So the way I look at it is that we've not only had experience in managing multi-assets and this kind of a product, we've also been very dynamic in terms of shifting from equity to debt to other asset classes. And that is reflected in the fact that the current multi-asset allocator fund of fund has actually, since inception, generated alpha not only above its own benchmark, but also above the Nifty. We also have other products in our product suite, which is the Kotak Equity Savings Fund and the Balanced Advantage Fund. Next slide. Where again, we have had considerable experience in terms of managing multi-asset products. So you can see that in all the three funds, both the multi-asset allocator, FOF, equity savings and balanced advantage. Of course, the equity portion is different for each fund in terms of the range, but across the funds, across the funds, what we have seen is that the upside downside ratio has been positive. That means the funds have been able to participate in the upside of the equity market far more than what they participate in terms of the downside of the equity markets. And therefore, through asset allocation, the overall risk adjusted return that these funds have generated have been superior. So therefore, now let's move on to the current product, which is the Kotak Multi-Asset Allocation Fund. It is a product which we believe is a load it, latch it, forget it kind of a product. So therefore, this is actually suitable to all kinds of investors, a first-time investor, existing investor looking at asset allocation, or an SIP investor or a lump sum investor. So it's a one-size-fit-all kind of a product that we are bringing to the table today. So let's look at the product in more detail. Next slide. Now, how is this fund different from our existing offering? So as I mentioned to you, we already have a multi-asset allocator fund of fund. However, the current fund that we are running is a fund of fund, and that fund is subject to debt taxation. And that fund has, from the commodity perspective, exposure to gold ETF. Now, the new fund is an upgraded version of the same fund. However, it is a better version and it is also a more tax efficient version. So the new fund, which is the Kotak Multi-Asset Allocation Fund, will invest directly into securities because we will keep equity, net equity at 65% in the fund. The fund will be subject to equity taxation, which we believe over a period of time is far more efficient. And the fund will have exposure to commodities, both gold and silver, through the ETF route or through the exchange traded commodity route, and therefore will be slightly more diversified from an asset allocation perspective as well. Now the fund brings to you, next slide. The fund brings to you, as I said, a proposition where it is one size fits all. It suits all. So whether you want to be bringing in money through the lump sum route or through the SIP route, the fund is appropriate because here the asset allocation is being done through the fund and by the fund manager. Therefore, this is suitable for first-time investors, investors who are looking at long-term financial planning, looking at professional asset allocation. So all kinds of investors can actually consider this fund. So how does the fund really work? So the fund brings to you essentially the power of 4. The 4 means there are 4 different asset classes that the fund will look at investing in. So I will explain each of this in detail, so just bear with me. The first asset class that we will look at is equity. Now, as I said, that this fund has equity taxation and therefore minimum net equity in the fund at any point in time has to be 65%. So the equity allocation will range between 65 to 80. However, what we are also saying is that if the fund manager believes that the valuations in the market are extremely expensive, the fund manager can bring pure directional equity down from 65% all the way to about 20%, and that will be done through arbitrage. So what do I mean by that? Now, as I said, that the fund has to keep 65% minimum equity. Now, if the fund manager wants to actually have 50% equity exposure in the fund, what he can do is he can bring down directional cash equity to 50, and the rest 15% will be made up through arbitrage. So using arbitrage, if markets become extremely expensive and valuations are very, very stretched, the fund manager can keep reducing the equity exposure closer to about 24% by using arbitrage to make up for the rest to ensure that the overall equity in the fund remains at 65%. Now, the fund manager will have a flexi cap approach in terms of the kind of stocks that he is putting in the portfolio and market cap allocation. So there is no constraint that you have to be in so much in mid cap or small cap or large cap. It is purely a flexi cap approach. The fund will be a diversified fund with about 50 to 60 stocks in the portfolio. So that's the equity part of it. Now, the other two parts, which is debt and commodity, because it's an asset allocation product, at any point in time, minimum debt will be 10% and commodity will be another 10% minimum. Now, on the debt side, the range of the asset will be between 10 and 25%. We will have dynamic duration management focusing on medium-term maturity. And on the corporate side, we will ensure that the portfolio has only high quality corporate bonds and therefore higher rated papers and not go down the risk curve. So medium-term maturity, dynamic duration management, as well as high quality corporate bonds will comprise the debt portfolio. Now, the third portfolio is commodities. And here again, minimum has to be 10% and it can go up to a maximum of 25. Based on macroeconomic factors, the range will be decided and it will be done through the ETF route or through the exchange traded commodity derivative route, which will have commodities as the underlying. We have a separate fund manager who will be specializing in commodity to manage the commodity portion of the fund as well. And fourth asset that we are looking at is the overseas assets. So here, if you notice, the range will be between 0 and 15. Now, we are saying that this is just a provision that we are keeping in the overall asset allocation bucket of the fund, but our allocation to the overseas part will be only very, very tactical. So it's not that we are going to take long-term directional calls on overseas asset allocation. As it is today, the headroom from a regulatory perspective to invest in overseas funds is very, very less. And therefore, we will look at it from a time-to-time basis, and this will be purely If markets correct, for example, if the Nasdaq corrects 25-30% from here and valuations look very attractive, from a tactical perspective, we will look at overseas allocation. But overseas allocation will also help in terms of diversification, both market diversification as well as currency diversification. So just let me recap this, and this is possibly the most important slide of the presentation. So there are 4 key asset classes and therefore the power of 4. Equity at any point of time has to be 65. However, pure directional equity can come down below 65, closer to 20, and the rest will be made up through arbitrage. The approach is flexi in nature, therefore there is no market cap constraint, and it will be a diversified portfolio of 50 to 60 stocks. Then there is debt, which is 10 to 25, commodity, which is 10 to 25, and there is a provision in the overall fund documents for overseas exposure through the mutual fund or the ETF route of 0 to 15. So these are the 4 asset classes that we are going to have in our portfolio. Next slide. Now the question comes is, how do we decide, what is going to be the asset allocation? The asset allocation decision primarily will be taken for equity. So what does this mean? So when market valuations are expensive, we will reduce equity exposure. When market valuations are cheap, we will increase equity exposure. And when markets are at fair value, we will maintain equity exposure. So the aim or the mantra is buy low, sell high. It's a very, very simple concept. And therefore, equity allocation will depend upon market valuations. And the up and down movement will coincide with markets becoming cheap or markets becoming expensive. Now, how do we decide where markets are cheap or where markets are expensive? We will use 3 key factors in our model to understand where we are in the valuation. in nature. And finally, before I open it up for questions, this fund in terms of the benchmark, next slide. So if you look at the fund in terms of benchmark, the benchmark of the fund will be a combination of Nifty 500 TRI, which is 65%, Nifty short duration debt index, which is 25, the domestic price of gold, which is 5, and the domestic price of silver, which is 5. Now, the fund manager for this fund on the equity part will be Devender Singhal. Devender already manages the multi-asset allocator fund of fund. Abhishek will be in charge of the debt portion. Hiten, who is our arbitrage fund manager, will look after the arbitrage portion. And Jitu, who is our commodity fund manager, will look at the commodity part of the overall portfolio. Now, Devender has been managing the multi-asset allocator fund of fund, and the fund, as I mentioned, since inception has not only managed to generate alpha over the benchmark of the fund, but has also through dynamic asset allocation and also taking right calls at the right time within equity and also the asset buckets, has been able to beat the Nifty since its inception. So Devender brings to the table a considerable amount of experience in managing such multi-asset products. And therefore, this is also something that we are bringing with this fund. We believe that from a market perspective, this is possibly a time to actually at any point in time, you should be doing asset allocation, more so in the current market, especially because equities as an asset class since the COVID period has given significant outperformance. And now is a time to look at incrementally from a longer term perspective, an asset allocation product, which will be dynamic in nature, giving you the upside of equity, but also protecting downside through asset allocation and therefore focusing more on risk adjusted returns. So I'll stop here and then we can take it up for questions and answers, please. Thank you very much.
Thank you, Shibani, for the detailed and precise presentation. So let us start our flow with the Q&A. So I will display the first question on screen. Just a moment. Yeah, so I'll read out a first question for you. Multi-asset funds, as the name suggests, have the flexibility to invest across equities, fixed income and gold. But do you think it is a right time to investing in gold at this point in time? I think you have already covered, but just to highlight
let me just also answer. It's an important question.
Yeah,
because you know, as you rightly asked, that as the name suggests, at any point in time, you will have investments in equities, fixed income and gold. So if you look at equity will be minimum 65, fixed income will be minimum 10 and gold will be minimum 10. So like when we do normal asset allocation, we should have some amount of gold in our overall asset allocation bucket. And even here, we will keep gold at a minimum of 10%. Now, whether we will move from 10 to 25 will depend a lot on our view on equity as well as debt. And therefore, if we are negative on both equity and debt, we will start increasing the gold portion. But at any point in time, gold will be there at 10 odd %. Now, what determines where gold should be in the portfolio? That will depend mainly on macroeconomic parameters and to some extent technical factors, which is going to be determined by the price of gold versus silver, etc. But typically, when does gold really outperform? Gold really outperforms when inflation moves up considerably and therefore gold is a hedge against inflation, as well as the fact that when there is global political or macroeconomic instability or uncertainty. So whenever you have, say, a conflict or you have a war, etc., gold at that point in time becomes the asset class to be in because it provides comfort and support from a downside perspective. So at this point in time, the way we look at it is that we will possibly keep gold somewhere close to the minimum or mid of that range because inflation is now coming off both globally as well as in India, and there is far more macro certainty. But whenever we feel that there is uncertainty or inflation continues to rise very sharply, we will look at increasing the gold allocation. Also remember, as I said, at any point in time, the fund will have 10% of the allocation in gold and silver.
Hello. Yeah, thank you, Shibani, for answering this question. We'll move to the next one. This is also an interesting question according to me. It's better to invest in different asset class separately and build a portfolio, or should we invest in multi-asset, which will do better according to you?
So
please throw your view on this.
Yeah. So I think that, you know, a multi-asset product, it brings the convenience of different asset classes, but through a single product. So if you are a person who has a lot of time on your hands, and if you are a person who has the right investment advisor, the right, if you are a person who has the right distributor who helps you understand different asset classes, monitor different asset classes, monitor valuations, macroeconomic factors, etc., and then you can do your asset allocation. Then you can go ahead and build a portfolio where you have different asset classes. But if you are a person who believes that you should leave the entire headache of moving from one asset class to the other to the fund manager, then this is a product for you. The second is when you are typically moving, especially between debt, equity, and equity back to debt, remember there will be a tax implication if you are doing it through separate assets or separate funds. But in this fund, because at any point in time, equity will be 65%, it will always have equity taxation. So from that perspective, if you are shifting from one asset class to the other, there will be tax implications at different points in time. But here, the taxation is going to be more efficient because it will be equity taxation. So please keep that in mind as well. And it really saves you a lot of headache in terms of, like I said, that, in our normal lives, how often do we look at our portfolios? How often do we understand macros? How often do we look at markets? How often do we look at valuations and decide that, yes, today I will move from one asset class to the other? And how quickly are you able to do it? If the answer to those are that I don't know, then this is a product to look at.
Yeah, thanks, Shubhani, for answering. Today we are having many good questions coming in. Okay, so our audience is likely to participate. So it is the third question will be, if someone have already invested in multi-asset fund, should he or she be adding the more to this NFO in the portfolio, or and yeah, how it would add value to it?
Yes. So now let me answer this in two parts. Now, if you are at this point in time want to increase your investments, so you have excess, so you have you received your bonus, you want to start a new SIP, even if you already have invested in a multi-asset fund, then you can clearly look at this NFO. So depending upon your savings, your long-term horizons, even if you have already invested in a multi-asset product already, then this NFO you can clearly look at. So like I said, this is a product which is, if you're a first-time investor, then obviously you can look at the product. But if you've already invested in a multi-asset fund, you're not a first-time investor. You are an investor who's looking at expanding his product portfolio. And therefore, if you have excess savings at this point in time that you want to invest, then given where equity markets are, you should look at a multi-asset fund. And therefore, this NFO makes sense in the portfolio. Now, how is it different from other multi-asset funds? That's a question that we get often because, as I said, there are already products in the market. Now, the concept is not different, right? Because this is not a novel concept in the sense that this is not something that we have come out with today. And therefore, the way the fund will be moving across asset classes or different asset classes, those asset classes are similar. The couple of things are different from our portfolios. One is that we have taken the enabling resolution to have overseas assets in our fund. So as I said, that 0 to 15% odd. That's number one. So that gives you overseas diversification and currency diversification. The second is our experience in managing multi-asset product has been very diverse and our experience has been extremely good as well. And as I pointed out that since inception, the current fund of fund has actually beaten nifty returns despite the fact that it is a multi-asset product. The third factor is finally between any fund house is the investment philosophy in terms of picking stocks and the process that drives the entire investment decision making for debt, equity, commodities, etc. And I think what we have demonstrated over the last many years is our philosophy and processes are very, very stringent in terms of how we look at stocks, the kind of research that we undertake in terms of investing in particular stocks, and that is reflected in how our funds are performed on a risk-adjusted basis across equity debt cycles. So I think these are some of the key factors that differentiate us from the other multi-asset products. But the concept of the product, to be very honest, is pretty much the same. It's not materially different.
Thank you, Shibani, for sharing your view. And we'll move to fourth question, which is equity, fixed income, and gold are becoming traditional asset classes. Are we adding any new class in this NFO? Yeah, this is interesting one again.
Yes, so one new class, we are calling it power of four. So equity, fixed income, and gold and silver are there in this multi-asset allocation fund. But we've also, as I was mentioning, that we've taken an enabling proposal to have some exposure to the overseas market through the mutual fund or the ETF route. So that's the new asset class which is there in our NFO. That if we believe that there is a tactical opportunity where, say, remember the time in say 2021 where markets, the Nasdaq had corrected very, very sharply, and that went on in 2022 as well. So if you get a situation like that, say for instance, the Nasdaq is down 30-35% or 40%. I'm just giving you just a number. I'm not saying that at this point in time, but it's just an example. But supposing you get a situation like that and you want to invest in overseas market, you can do it in this fund because we have that enabling proposal that we can take an ETF or a mutual fund, overseas mutual fund. But remember, this is subject to the regulatory cap that you have for the industry investing in overseas assets. At this point in time, the regulatory cap is open, but the headroom is only very, very small. So we can't take a large exposure anyways. So it is a new asset class, but subject to regulatory caps.
Yeah, thanks, Shibani, for explaining. And we'll move to the last question.
Sure.
What will be the equity allocation and which sector will be in focus, as well as please explain and touch upon the taxation part.
Sure. So let me answer the taxation part first. So this fund will have equity taxation. So as I mentioned, equity portion will be 65%. So if the fund manager believes that, the markets are very expensive and valuations are very, very high, he can bring down the cash equity part of the portfolio to below 65%. And therefore, equity will typically range between 20 and 80. But the rest of that portion of equity to bring it back to 65 will be done through arbitrage. So at any point in time, the fund will have net equity exposure of 65, which means the taxation will be equity taxation, where over 1 year, we will have long-term capital gains tax. What we have also seen, and why equity versus debt with indexation still makes more sense, is that the longer you stay invested in this product, the more efficient equity taxation is, and therefore we believe that from a long-term perspective, equity taxation is far better as a tax option rather than even looking at debt with indexation. So that's why we settled on equity. Now to answer your question is what will be equity allocation? So obviously the fund will end on the 14th of September, and after that we have 30 days to complete the building the portfolio, and therefore a lot will depend at that point in time. But if you ask me today, if I had to build the fund today, what we are seeing is that markets are slightly above long-term averages. That means markets are above fair value, and therefore our equity allocation will be neutral. Neutral means somewhere in the range of 45 to 50%. And as I said, if it's 50% equity, the rest 15 will be made up through arbitrage. So pure equity or cash equity will be about roughly between 45 to 50 is what we believe if we had to construct the portfolio today. The third question is which sectors will be in focus. So the way we have looked at it is that if you look at the earnings trajectory over FY24 and 25, the domestic facing sectors continue to contribute more to the earnings growth of corporate India. So the sectors that we will be positive on, and we are positive on today, include capital goods, industrials, infrastructure, defense. So that's one bucket. The second is the financial services space. Here there are different components. So it could be private banks, it could be some of the select NBFCs, could be select insurance companies and the like. The third is the auto auto ancillary segment, which we believe where there is runway for growth. And the fourth segment we are positive on is the real estate home building, which includes things like pipes, tiles, ceramic, cement. So these are some of the sectors that we are positive on at this point in time. And if you look at our portfolios, we are typically overweight on these sectors. So even to some extent, power is a sector where we are positive on. So these are few sectors which will be in focus in this product as well.
Yeah, thank you so much, Shivani. And
thank you.
Yeah, I would like to thank all our partners for the patient listening. And it's been really honor to listen to you, Shibani. And we are able to understand your perspective on this NFO and why we should push this NFO, basically. So I'm sure all my dear colleagues and partners have gathered a good amount of knowledge from this interaction. Thank you for interacting with us in weekend. And definitely thank you once again, Shibani, for spending time with all of us.
Thank you so much, and look forward to all your participation. And yeah, so all the very best, and have a great weekend. Thank you.
We too look forward for many such interaction with you, Shibani.
Yes.
Thank you. It's a pleasure listening to you. Thank you so much.
Thank you.
Yeah.
Bye-bye.
Bye. We can sign off now. Thank you. Thank you so much.
Thank you.
Yeah.
Bye-bye.
Bye. We can sign off now.